Welcome to Catalyst. I'm Madison Mills alongside Alexandra Canal. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we're going to hone in on the big tech trade as Meta's $320 billion rally comes to an end.
Plus, we dig into investors' rate cut expectations with Fed minutes out later today.
And a look at antitrust expectations under the Trump administration as the White House looks to mirror Biden's approach. Shares of Meta extending declines after snapping a 20-day winning streak on Tuesday, closing down by nearly 3%. The multi-week rally adding more than $320 billion to the company's market cap. Joining us now for what's next on Meta and some of the other big tech names, JJ Kinahan, Tastytrade at IG CEO. JJ, thanks for being here. You make a pretty bold statement on Meta. You say investors have turned bearish on the name. What do you make of that, given the run-up that we've seen into this really brief and kind of insignificant pullback in the context of that run-up?
Well, I think that you hit on it right in the intro there when you said, 20 days in a row, basically. This is a stock that in 2.5 weeks went from 670 to 740. Just seemed like a runaway train almost to the upside. And it's fantastic. And I just think what's happened over the last week, I actually don't know that this is necessarily a longer term trade for many people. But I think what happened is people were looking at this and saying, okay, this is kind of insane of how fast this stock has gone up without really taking a breather. And so I think many people were just playing it for what has happened over the last couple of days and seeing, things come back to earth a little bit because the pace it was going at seemed absolutely incredible, especially given what was happening to some of its peers and the fact that, other stocks were acting, I'll use the quote, more normal in terms of how they were going up with some down days, et cetera. So I don't know that necessarily this is going to be, when talk again, hopefully in a couple of weeks, I don't know that this will be a stock that I'll be saying that our clients are necessarily bearish on longer term, because this is one that if I look back just a month and a half ago was, almost 75% of the activity was buys. And you have to remember a normal for a retail trader is about 52% buys, 48% sells. And so when I see a stock like Meta right now, where we're seeing, almost 60% of the activity to the bearish side over the last 7 days, it just tells me that A, some people are taking profits, B, some people are just saying this move seems a little bit out of hand. And as I just looked at the numbers in the first, obviously we're only 30 minutes in, looking really quick coming in this morning, we are starting to see some people take off some of those positions and cover based on, be those options or stock positions based on the movement we've seen the last 2 days.
Now, JJ, that being said, though, Meta's run has outpaced all of its Mag 7 counterparts. So what does this signal about the investor appetite when it comes to tech? Obviously, we're still in a very concentrated market. Valuations are stretched. But does this signal maybe perhaps some buying opportunity?
Well, Alexandra, I think it absolutely does. And the other part about it is, the AI game continues. I think it's still, as we're starting to see more and more in the last earnings conference calls, it's now okay, you've spent this incredible money. And besides helping middle schoolers cheat on their papers and an incredible search engine, what are we really getting done? And I think we're all incredibly excited about what can actually come from this, particularly not just in the technology sector, but in the medical technology sector also. I think maybe the most exciting place that is eventually truly transformed by AI. But that all said, it's been billions of dollars spent with returns that I think everyone's left scratching their head. However, with that said, you have the biggest players in the industry all here spending that money, all of them with lots of cash in order to do so. So we are going to start to see, in my opinion, over the next year, you are going to see a lot more developments happen there. And when you have a company like NVIDIA, which obviously reports next week, I think the one thing many of us will be looking for in that is, do we still see overwhelming demand? I believe was the term, perhaps I'm paraphrasing a little bit, from their CEO in terms of what they are seeing. And all what the stocks are showing us right now is that seems to be the case overall.
Yeah, it's interesting because you say that the bulls are back when it comes to NVIDIA, but the stock is down about 0.3% year to date. What is the bull case for the company?
Well, I think if you look a little bit more, though, and you say, okay, what happened with DeepSeek? Here's a stock that's made back just about 90% of what that DeepSeek news was in terms of a threat overall. And so, again, I think also, when you head into such a big earnings, which they have now become, people may be a little bit more reluctant until it's a little bit of the show me case now in terms of what they will come out with next week. As I look at the options market here, we're pricing in about a 7 to a 7.5% move on those earnings numbers. So I think that also maybe have people holding back a little bit more. And so, in general, there is a lot to be excited about. And also the fact that if you look in 2024, this was a firm that in their fiscal year beat earnings on all 4 reports in terms of expectations. So I think that is also something that people have to look at.
Do you think the DeepSeek risk has not been appropriately priced into this stock? Because it seemed like it was a big deal, and then all of a sudden it wasn't. We're getting some headlines today that they're reportedly seeking some outside funding. So what do you make of how investors have digested the DeepSeek news?
Well, I think that it's again, sometimes the news from China can be a little bit tough to figure out in terms of the accounting. I think what I would say is that, if you look at what portion of development, when they said they did this for, I think it was $26 million, what part of the development are you talking about? You're talking beginning to end, and everything we're starting to see says, well, maybe not beginning to end, but maybe at the end processing, et cetera. So I think that there is what people have done is say, hold on, let's compare apples to apples compared to apples to the very small slice of an apple. And so that is why I think there remain some questions. However, I do think the real positive that came out of this overall was perhaps we as a country and maybe the tech industry had a little bit of sense of, I don't want to use the word arrogance, but we are superior and nobody can ever catch us. And so I think with this, it has been a bit of a wake-up call, which usually serves as a really good thing in business for people to say, hey, others are out there and they're going to compete just as hard. So you have to be sharp in your game the entire time. And that overall tends to be a good thing. And I think for NVIDIA, we're seeing with how the stock has responded back positively, it has been a good thing overall, and the continued rally in the chip and the sort of more full sector plays that you get with an NVIDIA.
One more tech name before we let you go. Apple, you're seeing bullish signals. What's the activity telling you?
Yeah, so we're seeing about 75% of the activity in Apple being positive right now. And, as we continue to see some of the AI with phones, et cetera, I think Apple was under a little bit of a cloud for a while. It's certainly come back. For so many years, Apple was sort of the favorite of retail. That fell out a little bit over the last year or so, but in the last 3 to 4 months, since the holiday season started particularly, we're starting to see a greater interest in Apple again from the retail trader overall. And that is, it's back in the top 5 names every single day after being, as I said, number 1 for so many years. So people continue to want to buy the stock, see the potential going forward, even with some of the geopolitical risks that it may have.
JJ, thanks so much. Appreciate your insights. We always love talking tech.
Thanks, ladies.
Well, to give a bit of context to Meta's recent run, markets and data editor and host of Stocks in Translation, Jared Blikre, joins us now to take a closer look at how the social media company's winning streak stacks up to longtime AI darling NVIDIA. Jared, what did you find?
20 days is really impressive. 20-day win streak here for Meta, and you can see it's up almost 20% on the year, which is a real standout when you compare it to these other mega caps. So considering the huge run-up that we've seen in NVIDIA, and I'll put this on a 3-year basis, you can see NVIDIA up 480% on this time frame. Going back 3 years, Meta up 238%, but how do they stack up in terms of the market cap gains? And that's something I was looking at right here. This is a 5-year chart, and this shows the rolling 1-year change in market cap over 12 months. And in white, we have Meta, and in NVIDIA, we have green. So in white here, you can see both of these securities, both of these stocks took a nice dip in 2022. That was that nasty bear market. That was when Meta cut their costs and a lot of heads in that area. But then they both had a resurgence. And by 2024, about Q2 or so, it was heading north of $2 trillion gained over the prior 12 months. And it fluctuated a bit, but it actually peaked out at about $2.5 trillion in December of last year. Meanwhile, Meta was continuing to tack on gains. And by the way, if this goes sideways, that means it's still adding to gains, but just at the same rate. So Meta kind of plateaued here, and even notwithstanding the 20-day win streak, we didn't really see much of an acceleration in terms of its market cap gains. So NVIDIA right now is just within a few percentage points of its record high, and I don't think that constitutes a bubble. You need two sides for the bubble, and so if NVIDIA is not in a bubble, I don't think Meta is either. But I also thought it was interesting to gauge how the Mag 7 stocks have contributed to the S&P 500 gains over the last few years. So I have 2023, 2024, 2025. The biggest difference you're going to see is this year we have a few losers. Those market cap losses going south there. And for that we have Apple, Alphabet, Microsoft, and Tesla. Tesla's down about $157 billion, so it's leading down this year, but you're also going to notice a few standouts. Now in 2023, there were about $5.1 trillion in market cap gains from the Mag 7, and this constituted 62% of the S&P 500 gains. The next year was similar. It was actually a little bit more market cap, $5.5 trillion, constituting 55% of those gains. And this year, well, it's only 126 million. That's about 1/30 of what we saw last year, and that percentage works out to about 5 or 6%. Now, we still have some standouts. In 2023, Microsoft was leading the charge, though we had a number of others that contributed similarly, Apple here and NVIDIA. But then in 2024, it was really an NVIDIA story, and that really stands out there. This year, guess what? It is a Meta story. Meta is kind of carrying the water for the Mag 7, arguably for a lot of the S&P 500 itself. So when we take it, to wrap it all up here, when we take a look at what's going on beneath the surface in terms of the mega caps and their market cap gains, it indeed looks like we have a healthy rotation in this market in 2025 because the S&P 500 and the NASDAQ 100 are hitting record highs, and yet we don't see the Mag 7 participation we used to. All of that just points to a healthy rotation in this bull market.
All right, Jared, thank you so much for breaking that down for us. We appreciate it as always. Coming up, Arista shares still moving to the downside after company earnings disappointing with one specific big tech customer. We're going to break down those results for you next on Catalysts. It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Arista Networks issuing a stronger than expected first quarter revenue forecast. The computer networking company also beating estimates for the fourth quarter, but it did see a 17% decline in revenue from Meta, one of their biggest customers. The stock under pressure as analysts warn about the company's reliance on Meta. And it's really interesting. Meta makes up about 20% of Arista Networks revenue. Microsoft makes up about 18%. So seeing that 17% decline in Meta revenue is really critical for the company, which, as a reminder, just for folks who may not be familiar, this is a cloud networking firm. They also provide AI-driven and data center products specifically. So that's one of the reasons we're seeing a company like Meta be such a critical customer to them. You think that Meta's AI capex increasing would be good for a company like Arista. So then to not see that coming through has been disappointing to investors.
Yeah, a little counterintuitive there. The concentration concerns really seems to be probably the sole factor dragging down the share price today because everything else looks good. I mean, coming into the print, there were some tempered expectations following DeepSeek, following some competitor reports. But outside of those Meta risks, I mean, analysts seem overall very bullish on the stock. We have 16 buys, 4 holds, just 2 sells, according to the latest Bloomberg estimates. Year to date, we're down around 7%. So it seems like what happened with those shares results that we're seeing today taking a big drag on the stock from a year-to-date perspective, but over the past 12 months, we're up over 55%. So a company to continue to watch as we always talk about the AI potential and what this next wave of the AI trade will really be.
Especially as that spending is expected to continue despite some of the headwinds from the likes of DeepSeek, which I know we're going to talk about.
Yeah, transition here to Alibaba, the Chinese e-commerce giant, weighs investing in AI startup DeepSeek, which is considering outside funding for the the first time. That's according to a new report from the information. So DeepSeek so far has not raised outside funding. They've been a little bit hesitant to do that. They don't want to commercialize their products too quickly, but the need for more AI chips, the need for more AI servers, and just the sheer panic, excitement, euphoria, whatever you want to call it, that we saw last month when it comes to that cheaper AI chatbot, it's leading this company to consider that funding. That's, again, according to the information. There's also been discussions about whether they should pivot away from primarily focusing on research and maybe towards building a business that generates some profits, some revenue. But the DeepSeek founder, he remains cautious. So it's still a big TBD whether or not this will happen. But again, Baba reportedly considering investing in the company and some other China funds as well.
Which, to your point, so interesting given that just 2 weeks ago, Baba said we were absolutely not considering this investment, and now suddenly DeepSeek's open to it, so is Baba, which makes sense given that the usage of DeepSeek has really skyrocketed following news about the viability and efficacy of its AI offering here. It's also interesting to see them transitioning potentially to this for-profit model. That's something that investors and sources I've been speaking with have really pointed out is the critical differentiator of DeepSeek. If they do find a way to make a profitable AI platform, that could put further pressure on some of these American-based companies that are offering AI tools like an OpenAI, which has not transitioned to that for-profit model perhaps as successfully as some of the competitors in the space.
Yeah, and look, they have the momentum, right? I mean, everyone is talking about DeepSeek, and they weren't a few months ago, and now all of a sudden, to kick off 25, it's all a lot of companies and a lot of investors are chatting about and they're focused on as we think about the future of these trades and also those hyperscalers.
Right, and they need more chips to fuel all that usage going on. We're going to transition to a consumer-facing name here, Etsy, missing fourth quarter revenue estimates, weighed down by weak holiday sales. The online marketplace citing consumer spending pressure, a short holiday season, and a competitive retail environment. But interesting to note always when you compare across the retail space, that holiday shortened environment was the same for everybody. It didn't impact everybody negatively. So that's important to note. Those shares down about 9.5%. What's really interesting for Etsy, they've been in this route since 2022. They saw a huge run up following the pandemic, and then you've seen just this severe move to the downside, and they've been in this kind of holding pattern, kind of sputtering along over the past year here, and you can really see that playing out in your screen since about May of 2024. They were able to hit a revenue record, a historic record on revenue, but their global merchandise sales fell. And if they don't turn that piece of the business around, that's something that people are concerned about and investors are concerned about when it comes to screen time and the amount of spending on the platform being able to continue.
Yeah, and the merchandise sales, that reflects a drop in discretionary spending. And we always talk about the consumer here and the health and the resiliency of the consumer. We did get that not so great retail sales number for the month of January, but a lot of economists, a lot of strategists basically saying seasonality, weather, we had a really strong December, but interesting to see and continue to track the moves that we're seeing throughout the consumer at large. And, you know, with weaker gross merchandise sales in the fourth quarter, that's likely to continue in the current quarter. So something to continue to watch for this company. Stock, as you mentioned, was down about 25% over the last 12 months. It's underperforming the S&P 500. Just, it seems like we need another catalyst here for really boosting those share prices because it's not a cheap stock either at current levels.
Well, and perhaps that catalyst is within Etsy. They are the owners of Depop, which we were just talking about. It's kind of like a Poshmark, an online marketplace for those not familiar, a little bit more vintage leaning, but Depop hit a record in terms of global merchandise sales. So maybe if they're able to lean into that platform, which could also be an indicator of consumer weakness, if people are looking for that resale option, something that you and I maybe need to.
I know, I haven't used Depop, but you're telling me that I need to do it. So with all the weddings and all the work events, everything coming up, I might have to look into it.
It's an affordable wedding guest dress option out there. Exactly.
It ain't cheap to go to weddings.
It ain't cheap to have friends. All right, folks. Well, as we head to break, we want to hone in on healthcare as Yahoo Finance executive editor Brian Sozzi spoke with Bausch & Lamb's CEO Brent Saunders on opening bid this morning about the growing problems facing the industry. Take a listen.
I think there's a lot of blame to go around. It's a very complex system with lots of different moving parts. And I think the fix is quite complicated, but if I had to pick one area to really focus on to fix it, I really think it's quite simple: transparency. I think that, you know, if we look at what Doge is doing, right, and you know, whether you like it or dislike it, the one thing it's hard to criticize Doge on is they're bringing massive transparency, right? They're putting out on the web or on X every day, what they're doing, what programs are being canceled. We should have real pricing transparency on healthcare services in the United States. We should understand why we pay what we pay, where you can get it perhaps at a lower cost, who's getting paid, where is the money going. And I think if you do that, you're going to find a lot of inefficiency in the system.
A big question on Wall Street is how President Trump's tariff agenda could impact the Fed's path forward, especially when it comes to inflation. Earlier this week, Fed Governor Michelle Bowman said she's looking for further confidence on inflation's downward trajectory before considering further cuts. Meanwhile, Fed Governor Christopher Waller advocated for a pause in easing, but also said, quote, waiting for economic uncertainty to dissipate is a recipe for policy paralysis. Joining us now for more, we've got Thomas Honig, former Kansas City Fed president and also former director of the FDIC. Thomas, great to have you on. Thank you for making time here. Talk to me about the path forward for the Federal Reserve, given the stickiness of inflation. This morning, I read BNP Paribas saying that the Fed is comfortably numb. Would you agree with that characterization?
I would say that the comfortable part of it may be a little of an overstatement. They are certainly holding where they are. And I don't know that they're all that settled, because with inflation going up the last couple of months, and given where their interest rates are, and their real interest rates are now well below 2%, they have been a little more concerned about inflation, and they should be more concerned about inflation. So I don't think numb is the right.
Thomas, did we lose him? I think
we might be losing you, Thomas, so we're going to see if we can get you back. But Ali, I think it's really interesting hearing him kind of talking about the question about whether or not the Fed is right to be in this holding pattern. And it points to something that so many investors have talked to us about on the show, the idea of whether or not the Fed has a central thesis that's driving it, and something, of course, we can continue to talk about with Thomas.
Yes, we have Thomas back now. And Thomas, I want to pick up that conversation because markets are pricing in between 1 to 2 rate cuts this year. If we do see rate cuts, you were mentioning how inflation has been sticky. Are those cuts going to be a result of decelerating inflation, or are you concerned that we could see a potential hit to growth, maybe a deterioration in the labor market, especially when we think about some policies that are circling around Washington with tariffs and some other global concerns?
Well, I think your situation right now is a great deal of uncertainty, right? Around the tariffs. We don't know what they're going to be exactly. We keep talking about it. They will have impacts on our domestic economy as well as other economies. So those are things that you can't really know. And so it adds to the uncertainty, and that slows people's so-called animal instincts to invest and to go forward. So that is a risk that we have. I think, though, that remember, the issue that they have right now, though, is inflation is not coming down. And so they really have to hold rates. So if there's something that happens, an unexpected slowdown, a banking problem, then they will be under a lot of pressure to lower rates, number one. Number two, even if things stay where they are, given the size of the national debt and its growth rate in terms of its deficit, that's going to put pressure on having to finance that debt. That puts upward pressure on interest rates, and they have to deal with that as well. Do they say, well, we'll offset that and buy those securities and then push interest rates down? That has more implications for inflation. So they're in a tough spot right now, is what I'm trying to say.
They are in a tough spot, and it's been interesting in the context of some of the Fed speak this week. There's this idea from voting members that they just have to look past policy from the Trump administration. But I wonder how difficult that is, especially given some of the cost-cutting measures we've seen from DOGE. If we take a look at layoffs just in D.C. in particular, some of the biggest layoffs in history, you can see jobless claims in the D.C. area here really ticking up. Could cost-cutting efforts from the Department of Government Efficiency combined with these layoffs potentially cause a recession, especially if the Fed is not willing to take a look at the impact of policy from the White House?
I think that even though the numbers are coming up in Washington, D.C., I think in the national scheme of things, we still have a very strong labor market. And I'm going to suggest that many of those who are being unemployed in the Washington area can find other jobs, perhaps not where they want, though, and that may be a problem. But I don't think that's going to cause a recession itself. Now, if this picks up in terms of news and you start affecting businesses' decisions, and you add that to the inflation, and you add that to the other actions that are being taken in terms of tariffs, well, then you can create a certain degree of fear and greater uncertainty, and that may slow the economy, and that would put more pressure on the Fed to lower rates, even as the debt continues to grow. And I think even as real rates have come down quite a bit. I mean, they're well below 2% right now. If you look at where the policy rate is at 4.25% and where inflation is at 3%, your real rates are certainly at neutral, lower than that. So you have a mildly accommodative policy possibly, and that means inflationary pressures will not recede anytime soon.
Thomas Honig, appreciate your insight. Thanks so much. Coming up, antitrust under the Trump administration, why deal-making may not see the uptick many were expecting. That's next on Catalysts.
In a blow to Wall Street, the Trump administration says it will keep Biden-era guidelines for reviewing corporate mergers. Investors were anticipating an increase in deal-making with easier antitrust regulation under Trump 2.0. Joining us to discuss the news, Rebecca Hollinsworth, Vanderbilt Law School Associate Dean for Research and Professor. Rebecca, great to have you with us here. What does keeping rules of the Biden era mean? Walk me through kind of operationally what this looks like and what it means for M&A.
Yeah, so in 2023, the Biden administration put out new rules about how the agencies, the FTC and the DOJ, were going to internally review mergers for whether or not to try to block them in court. And they were thought to be a lot more stringent than what came before. This was kind of a part of the Biden administration's, tougher on mergers, more aggressive antitrust enforcement. And I think in somewhat of a surprising move, the Trump administration, at least the FTC, has announced that they're going to keep the merger guidelines in place, at least for now. It's not law, it's not binding, but it's a description of what the agency will do going forward.
So what's some of the criteria here that the FTC and the DOJ use to determine whether or not to seek to block a merger?
Well, it used to be under the old guidelines that you had to basically show two horizontal competitors, so competitors selling substitutes, were merging in a highly concentrated market in order to get serious scrutiny from the FTC or the DOJ, and then ultimately to maybe have it blocked in court. The new guidelines describe a lot of other factors that might give rise to challenges. So, vertical mergers or mergers between complements, mergers that affect the concentration of buying power, including buying power of workers, being a big one. So it's just a broader set of considerations that the government will consider.
It's interesting because the market has been so bullish on easing M&A regulation under Trump 2.0, and we've, as part of that, seen this huge run-up in financial stocks because of this idea of increased deal-making. You can see on your screen the financial sector up 7.5% year-to-date, beating out some of the other big sectors as well. How offsides do you think the market has been in pricing in an easier backdrop for deal-making?
I think it's been off. I think this is surprising. However, I would have always said, and I did always say, that our confidence in these predictions is low. We just didn't know what Trump is going to do. And part of that is because this push for stronger antitrust enforcement and stronger merger enforcement in general, blocking more deals, started with Trump 1. So it wasn't ever clear to me that, obviously they're going to back off. They're going to let mergers go through that didn't go through under Biden. I would have thought that is more likely, and maybe that's what got priced into the market. Yeah. But the confidence in that prediction was never should have been high.
Especially given the closeness we've seen with some of the big tech CEOs attending inaugurations, sitting ahead of some of his own advisors. Do you think that these Biden-era regulations are going to be specifically targeting or specifically negative for big tech as opposed to other maybe smaller cap companies that may have an easier time with M&A?
Well, I think you've kind of put your finger on it, which is, tech and mergers and industry is not a monolith. So there are going to be winners and losers in this administration's attitude towards mergers, and I think it's very unclear who those winners and who those losers are going to be. I think that big tech, there's still some political capital in going after big tech. Elon Musk is not Google, is not Apple, but it's just very hard to say who's going to be the winners and the losers.
Now we're in Trump 2.0, so we can look back on history as a bit of a guide, you could say. So in Trump's first administration, how tough was he on mergers?
So tougher than what came before, and not as tough as the Biden administration. So Trump's first administration challenged a vertical merger in telecom. That would have been somewhat unusual and maybe not at all happening during the Obama era. And then Lina Khan, when she was in charge of the FTC, and Jonathan Cantor in charge of the DOJ under Biden, they really went for it. So, will this be a pullback a little bit? Will it be the same? It's very hard to say. But I mean, we look at history and we say Trump 1 versus Trump 2. It's very hard to really make any generalizations about Trump 2 from Trump 1, as we're seeing across the administration's choices.
How surprising is it to you that they are branding this as a continuation of Biden-era policies as opposed to just given the rhetoric that we have seen from the administration, they do tend to find a way to make the old their own. Did that characterization catch you off guard?
I think it's really surprising. I would have thought that Trump and Trump's, people in his administration would have wanted to show a discontinuity with Biden. If anything, maybe a continuity with their first administration. They could have framed it that way, saying, these are priorities that we pursued in our merger policy the first time around. But instead, they kind of went for this almost like rule of law, continuity, stability point, which I think is not what we've seen from the rest of the administration in terms of their branding. I think that's right.
And you mentioned that stability point, FTC Chair Andrew Ferguson arguing that. Now, do you think this means that we will continue to see just stricter restrictions around M&A moving forward, even beyond this administration?
Oh, beyond this administration, I mean, that's a long ways off. It's hard to say. I mean, certainly if he had jettisoned the guidelines today, then that would be less stability, long term, and we could have said that. But, it's 4 years away. It's a little unclear from the memo to me whether this stability he's hoping, Andrew Ferguson is hoping will last through all 4 years. He left open the idea that maybe they would revise or pull out of the guidelines at some point later, but for now, they're going to keep it. I think that's really all we know.
All right, Rebecca, thanks so much. Appreciate your time.
Thank you.
President Trump taking to Truth Social this morning to back a House budget plan calling for a $4.5 trillion tax cut, slapping back Senate Republicans' efforts to rush through funds to help bolster his immigration crackdown in favor of a larger bill that will likely take months to negotiate. So Trump really getting in the middle here of this ongoing budget conflict. We have a key congressional vote coming up. The Senate plans to vote this week on a budget that would add $150 billion in military spending and also increase immigration and border enforcement by $175 billion. So Senate Republicans say they prefer to focus on this, leave budgets aside for now, but Trump wants to really back this sweeping House bill to essentially tackle the federal spending. But that brings into question, too, the deficit, right? And a lot of these tax cuts on both sides of the aisle, both Republican and Democrat, have wondered how that could add to the ongoing and ballooning deficit that we see.
There is this idea that the tariff announcements that are nearly every day coming from the White House are going to pay for these tax cuts. So perhaps President Trump's push towards what he calls, quote, one big beautiful bill, is an effort to increase some of that viewed revenue, not realized revenue, in anticipation of these debates about tax cuts within the Senate. But it is interesting to see him sort of rebuffing Senate Republicans who did want that $175 billion in increased spending for immigration enforcement specifically. We're now seeing him, again, pushing for that bigger reconciliation bill that will include kind of a one and done. This is something that Treasury Secretary Scott Bessent had also teased out earlier this year. And even in my conversation with him here on Yahoo Finance, the idea of pushing for one big beautiful bill that includes all of these tax cuts from the administration. I think it's positive for markets, though, I would imagine, that he is focusing on those tax cuts over some of the immigration policies. There was a question about whether or not the Senate would push him to focus on immigration first, and now we have him saying no to that.
And a lot of economists out there have started to talk and have conversations about how the immigration that could trickle through into the jobs market. And we've seen a very resilient labor market, but any further deterioration on that part, that could be a trouble point for the Fed. So immigration is something to also keep in mind. All your action, markets action ahead. Stay tuned. You're watching Catalysts.
Vanguard's S&P 500 ETF VOO has overtaken State Street's SPY as the biggest ETF in the world, with almost $632 billion in assets after adding about $23 billion so far in 2025, according to Bloomberg. So what does this tell us about where investors are finding opportunities in the ETF space? Here with more, we've got Gavin Filmore, the Chief Revenue Officer at Tidal Financial Group, joining us now for this week's ETF report brought to you by Invesco QQQ. Great to have you on. So VOO, now the biggest ETF beating out SPY. And I've had people explain this to me as VOO is better for investors, SPY is better for day traders. Would you agree with that characterization? And for those looking to build wealth and have a little bit more of a passive ETF approach, which is better?
Yeah, I mean, it does come down to basically that. So that's a great point. And it's a real milestone to see these two products at such large AUM levels. But as you suggest, SPY, which has been around the longest, still arguably has the best liquidity in the market, which is good if you're trading more often. It becomes more important. That being said, VOO's fee is lower. So if you're kind of a buy and hold investor, VOO might be more favorable than SPY, but obviously both very healthy products. We can see in that chart, they're both growing. And that's probably a reflection of the top line growth of the ETF market more than anything else.
So you mentioned that lower expense ratio for VOO, so appeals to those fee-conscious consumers. I guess the question for me is, in what case would you want to pay up for that higher expense ratio?
Sure. I mean, active management obviously comes to mind there. You can't get active management for the same price as a passive ETF. And that should be fairly logical, right? It takes dedicated active managers behind the scenes, these PMs that are managing those funds. So paying up for that type of management, certainly in different market environments, or when you're trying to get niche exposure, makes a lot of sense. And then there's other factors, just like the competitive nature of the business itself driving fees down. So if you're looking for something more unique, more novel, you might expect to pay more for it, but it may have a very good use case in a portfolio.
It's been interesting to see how ETFs have evolved specifically since the pandemic. And I want to talk specifically about the Meet Kevin ETF. The YouTuber closed that ETF after a slew of challenges, including a negative performance and high fees that led to not a lot of popularity in the ETF. But how should investors be finding clarity on both complicated but also potentially just not high return ETF opportunities like something like the Meet Kevin ETF?
Yeah, I mean, to talk about the Meet Kevin ETF for just a quick second, we're actually pretty impressed by what it was able to achieve. Obviously, we don't like to see product closing. That being said, it was very unique, very novel, and it did garner 50 million in AUM rather quickly, and then it sort of fizzled out a little bit, and I think Kevin decided to move on and focus on other things. That being said, it was a good example of innovation in the market. Back to your question with respect to, how should people look at their portfolio, look at performance, look at fees, it comes down to education, obviously knowing what they buy, and reassessing their portfolio on a very regular basis, and making sure that their products are performing as they would like, looking at other alternatives, and sometimes making changes when appropriate.
Let's talk about some of those alternatives, derivative ETFs. They're gaining popularity, but they can be a bit complicated. What types of derivative ETFs exist on the market? And really, who's the buyer here? Because oftentimes they can be volatile, correct?
They can be volatile, or they can be the opposite of volatile. The amazing thing about derivatives is that they allow you to express exposures that can't be done without derivatives. So if you want, for example, protection on the downside, the defined outcome ETFs, which for me were very much a watershed moment in the utilization of derivatives, for the ETF market, those are protecting downside and giving people more muted exposures. That became very important during, times of stress like COVID and so on. Other products, as you suggest, may focus on other areas like leverage. So one of the first utilizations of derivatives in the ETF market were with leveraged ETFs because you can't get leverage without derivatives. And those are more for day trading. And then recently, it's really become income that's been a focal point. And I think that started with the zero interest rate environment, but now has just led to further adoption. So, pulling back a little bit, what we've seen is a lot more acceptance of derivatives as tools that can be very, very effective in portfolios.
All right, Gavin, we got to leave it there. Thanks so much for joining us this morning. Appreciate it.
Thanks for having me.
Let's get a check-in on shares of Apple ahead of its plans to launch a new product today that CEO Tim Cook described as the newest member of the family. The stock is down about 0.3% ahead of the event. We're going to have more coverage on that event and the product announcement later this afternoon, but I do want to take a look at the major averages still under pressure here. You got the S&P 500 down about 0.2%. Your tech-heavy NASDAQ down just about 0.3%. And it's interesting seeing some of the big tech names sort of faltering so far this year. You've got 7 of the S&P 500's top 10 contributors this year being non-Mag 7 names, which is interesting in the context of the Mag 7 being responsible for so much of the double-digit rally that we saw in the S&P 500 over the past 2 years. That leadership change-up still happening, especially when you take a look at some of the sectors like financials and energy leading the gains so far today. Well, that's going to do it for me and Allie. Coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith will have you here for the next hour, so stay tuned for more.